Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're embarking on a really crucial deep dive into the world of payday loans. It's a topic that, impacts millions of individuals and families, and it's an area of personal finance that often feels, well, kind of shrouded in judgment or maybe misunderstanding. But it's really essential for all of us to truly grasp its mechanics and implications.
Exactly. And whether you're just starting your financial journey or maybe you consider yourself pretty adept at managing money, understanding payday loans is, well, it's critical for making truly informed decisions. We're going to pull back the curtain on their history, meticulously unpack how they actually work, explore who uses them, and importantly, why. And then we'll delve into the broader financial and, the ethical implications they present. It's a complex landscape for sure, but we really aim to make it crystal clear for you.
Right. Our mission here is simple: to provide you with a clear, comprehensive understanding of this incredibly complex financial product. We want to equip you with insights that go far beyond, the surface level headlines or those quick opinions you see everywhere. We're going to dive deep into the hard data, explore the real life experiences that shape this market, and examine the rapidly changing landscape of small dollar credit so you can walk away feeling genuinely well informed. Let's truly deep dive into it. Okay, let's unpack this then. When we talk about payday loans, we're not just discussing a single product in isolation, right? We're really talking about one significant part of a much larger financial category known as alternative financial services, or AFS. So, what exactly does that encompass, and what sets these types of loans apart from, say, your typical bank loan or a credit card?
Yeah, that's a great question to start with because it really sets the stage. Essentially, AFS are financial products typically offered by lenders that aren't traditional banks. Think of them as operating sort of outside the mainstream banking system. They're often catering to individuals who might not have access to conventional credit lines or, who might even be unbanked or underbanked. Payday loans are probably the most common and widely recognized for sure. But this category also includes things like auto title loans and pawn loans. Let me quickly explain what each of these involves so we can see the full picture here. Okay, first up, payday loans. These are typically very short-term, small dollar loans, often for amounts less than, say, $1,000, and they're explicitly designed to be repaid on your very next payday, which is usually within like 2 to 4 weeks. The mechanism is pretty direct. You're generally given the cash in advance for a fee, and in return, the lender secures repayment by getting either a post-dated check from you, or much more commonly now, permission to electronically withdraw funds directly from your checking account when your paycheck hits.
Okay, so they get direct access to your account.
Exactly. They're marketed as a bridge, for a very short-term financial gap. Then we have auto title loans. Here, the title to your vehicle, your car title, serves as the collateral for the loan. So you literally hand over your car's title.
Wow. Okay.
Yeah. Like payday loans, they are for relatively low amounts, but they carry incredibly high interest rates and are generally short duration, often just a month or less. The scary part here, as you can imagine, is that if you can't repay the loan, the lender can repossess your car.
Right, which could be devastating.
Absolutely.
Yeah.
Especially if that vehicle is your only means of transportation to work or school or for childcare. It can unravel everything. And finally, pawn loans sort of round out this category. These loans use a valuable item. It could be jewelry, electronics, tools, even a computer as collateral. You physically give the item to the pawnbroker, they assess its value and give you a loan based on a percentage of that value. You then redeem your item when you repay the loan, plus fees and interest. If you don't repay within the agreed-upon time frame, the pawnbroker simply keeps the item and can sell it to recoup their money. Now, while you don't face like aggressive collection calls or credit score damage like with other loans, you do lose your possession.
Okay, so if I'm understanding this correctly, all of these AFS loans share some key characteristics. They're relatively small in size, they come with significantly high costs, and they have very, very short repayment periods. That high interest rate is like especially eye-opening. What often surprises people, I think, is how a seemingly small fee translates into just an astronomical annual percentage rate. For instance, you mentioned a $100 payday loan with a $15 fee due in just 2 weeks. That actually translates to a staggering 391% annual percentage rate, or APR.
Mhm.
And I think it's really critical for you, our listeners, to remember that APR is the most effective way to compare different loans and credit cards. It standardizes the cost over a full year, making it easier to see the true expense and not just that immediate fee.
Absolutely. And While these loans are often presented just in terms of a flat fee, like that $15,400 example,
Hmm.
understanding the APR equivalent is, well, it's absolutely crucial because it truly highlights the annualized cost. I
Yeah.
mean, to put that 391% in perspective, the average APR on a credit card was around, what, 16.04% in 2019?
Yeah, that's 16%.
Right, we're talking orders of magnitude higher.
Hmm.
And this immediately raises a really important question, one that we need to genuinely explore. If these loans are so costly, right, if the interest rates are so exorbitant and the terms so restrictive, why do millions of people still turn to them? Why do they persist as such a common financial tool for so many individuals and families across the country? It seems counterintuitive.
It really does. And that leads us straight into our first key takeaway today, which is a bit of a paradox. Payday loans are incredibly widely used, and for many people, they don't just solve a one-time problem. They actually become a persistent, almost engineered part of their financial life.
That's such a critical insight because the numbers really underscore the sheer scale of this reliance.
Hmm.
Let me share some data points just to illustrate how prevalent these loans really are. Back in June 2019, our data indicated that about 4.4% of consumers had taken out a payday loan in the previous 6 months.
Okay, 4.4%.
Yeah. For auto title loans, it was 2.0%, and for pawn loans, 2.5%. Now, while these percentages might seem small on their face, you have to remember we're talking about a population of hundreds of millions. These figures represent millions of households across the country relying on these alternative financial services, just to make ends meet. It's a really significant portion of the population.
What I find so striking here is that even with slightly different survey methods or, different time frames, these figures consistently pop up across various studies that have looked into consumer financial behavior. It's definitely not an anomaly. And you might initially think, okay, these are just isolated one-off emergency uses like a temporary stopgap, a bridge over troubled waters, right? But the data tells a very, very different story. It reveals how often these loans are actually rolled over or reborrowed. And that turns them into a much longer term commitment than people initially perceive. That's the part that really shifts your perspective, I think.
It truly does. The persistence is just undeniable. For consumers who had taken out a loan in the 6 months prior to that June 2019 survey, a significant portion still owed money on it at the time of the survey. We're talking about 63% for payday loans.
Wow, nearly two-thirds.
Yes, nearly two-thirds of borrowers were still in debt from a loan taken out months before. For auto title loans, the figure was even higher at 83%. And for pawn loans, 73% of borrowers still owed money. This isn't about quick relief. It clearly indicates a deeply entrenched pattern of dependency rather than, quick one-time repayment.
When you look at those percentages, it really paints a picture of so many people essentially getting stuck in a cycle, just stuck. I've heard countless, honestly heartbreaking stories from people who describe it as a payday loan hell or a debt trap, and these numbers absolutely back that up. I remember one person sharing how they initially took out $1,500 in payday loans, genuinely believing it would be a temporary fix for, I think it was a car repair. They ended up paying thousands in interest over just a single year. And they later realized, looking back, they probably could have paid off the principal in only 3 paychecks using a different option they had. But instead, it became this constant, exhausting cycle of paying back, immediately reborrowing, and just signing papers over and over again. It sounds like a treadmill you just can't get off.
That analogy of a treadmill is absolutely spot on. We see this pattern so clearly in the data. For payday loans specifically, nearly half, 48%, almost 1 in 2 of consumers who had taken one out in the previous 6 months reported that they had rolled over at least one payday loan.
Nearly half rolled over.
And it gets even more intense. Another comprehensive study found that an astonishing 80% of payday loans are rolled over or followed by another loan within just 14 days.
Within 2 weeks.
Within 2 weeks. And a significant 74% of borrowers borrowed again within 8 weeks. This isn't just a few isolated incidents. It's clearly the dominant mode of how these loans are used in practice, pointing to a real systemic issue.
Now, okay, it's important to recognize, maybe for context, that this rollover behavior isn't entirely unique to payday loans. For example, our survey data showed that 51% of credit card users didn't pay their full bill in the previous month, meaning they too were revolving debt. But, and this is the crucial difference, the astronomical rates and fees for payday loans amplify the problem dramatically. Revolving a credit card balance at, say, 16% APR is vastly different from doing so at 391% APR or even higher. The former can be like a slow financial bleed. The latter is a financial hemorrhage.
Indeed, exactly. And the persistence over longer periods is also striking. Just over half of the consumers who took out a payday loan in the first half of 2019 had taken another one in the subsequent year.
A year later, still borrowing.
Yes. For pawn loans, it was 56%. This strongly suggests that once you're in that system, it can be very, very difficult to get out, creating a really long-term financial burden. We also observed some interesting, albeit temporary, changes during the early months of the pandemic. The share of consumers still owing money on payday and pawn loans actually fell, which is consistent with many consumers using government transfers like stimulus checks to pay down various forms of debt. That makes sense.
Right, they had a little breathing room.
Exactly. However, for auto title loans and credit card debt, the percentages remained largely unchanged during that specific period, which just highlights how different financial products responded to those unique economic conditions and government interventions.
Okay. Given what we've just discussed about the persistent nature of these loans and that cycle, it really begs the question, who are these individuals? And what compels them to turn to such costly solutions, especially when, as we'll get into in some cases, other credit options seem to be available? This leads us directly to our second key takeaway. People often turn to payday loans during times of significant financial shock, even when seemingly lower cost credit might technically be at their disposal.
Right. Let's start by looking at the demographics because that offers some important context for understanding the who. While alternative financial service users come from incredibly diverse backgrounds, it's true that certain groups are indeed more concentrated among them. We found higher usage among those aged 40 to 61, individuals with a high school degree or less education, Black and Hispanic consumers, low-income households, and women. For instance, 68% of AFS users had at most a high school degree, compared to just 44% of non-AFS users.
That's a big difference.
It is. And 21% of AFS users earned $15,000 or less annually. That's a stark contrast to only 9% of non-AFS users.
So this demographic breakdown really suggests a common thread of, well, financial vulnerability and maybe limited access to traditional financial safety nets among many users.
But the why is where it gets really interesting and perhaps a bit perplexing for those of us who don't face these immediate kinds of pressures. These loans are often marketed, as you said, as quick fixes for unexpected emergencies. Imagine a sudden car repair that costs hundreds, or an unforeseen medical bill, or even just a traffic ticket that completely throws off a tight monthly budget. And the data does align with this marketing. A large majority, 77% of AFS users, experienced a financial shock and had difficulty paying a bill or expense right around the same time they borrowed. So it paints a clear picture of immediate urgent need. Yes, it certainly seems to. And what's crucial to understand here is that for those who had difficulty paying a bill, the average cost of that difficulty often exceeded the immediate liquidity they had available from all their existing sources, whether that was savings, credit cards, or other quick cash.
So you mean even their savings and credit cards combined weren't enough?
That's right, exactly. When people faced these difficulties, 50% chose to borrow money, either using formal or informal credit. And of those who borrowed, 21% turned to an alternative financial service. This suggests that for many, AFS wasn't simply a convenience or like a preference. It was perceived as a necessary step to cover an immediate, unmanageable expense that had just caught them completely off guard.
So, okay, on the surface, it definitely sounds like a desperate measure, an unavoidable last resort for many. But here's the puzzle, and this is what I find particularly intriguing and maybe a bit confusing. Our data show that many AFS users actually do have other credit options, including credit cards, that are typically much lower cost. We found that 63% of AFS users had an active credit card.
Over half.
Yeah. And even more surprising, 28% of current payday borrowers had at least $300 in available credit card credit sitting there. For auto title borrowers, it was 33%, and for pawn borrowers, 16%. So the big question is, why wouldn't they simply use those seemingly lower-cost options that are already at their disposal, rather than turning to a payday loan with a nearly 400% APR? It doesn't immediately make sense.
Right, this is a vital question. And it really challenges some common assumptions about consumer behavior and, financial decision-making under pressure. As you pointed out, the interest rate for credit cards is typically much, much lower than for AFS. So one possibility we explored was, well, maybe AFS users are just less likely to shop around for the best terms, perhaps prioritizing speed and convenience over cost.
Like they just need the cash now.
Exactly. However, interestingly, what we found was that those AFS users who did have available credit card credit were actually more likely to say they search for the best terms.
Oh, that's surprising.
It is. So this suggests that simply not shopping around isn't the full explanation for this puzzle. It's definitely more complex than that.
Okay, so what does this all mean then? How do we understand why people choose these high-cost loans, even when they seem to have other options? It sounds like for some, the sheer scale of the financial shock they experience is simply too large for their existing savings or their available credit card limit to adequately cover. It makes AFS part of a broader, maybe more complicated strategy to deal with these really tough difficulties. We found that the median bill or expense for an AFS user was actually higher than their median combined savings and credit card liquidity. This led to a median deficit of $800 after a shock.
Mm-hmm.
$800.
And think about it. For someone earning $15,000 a year, an $800 deficit is devastatingly large. It's more than half a month's income. So it's not really about avoiding a credit card. It's about facing a shortfall that even their existing credit can't fully bridge, pushing them into a truly desperate position where they might need multiple sources, including AFS. That's a really important clarification. The size of the shock matters immensely.
Which brings us then to our third key takeaway. The payday lending business model itself is often criticized as being inherently unethical, primarily due to its reliance on repeated borrowing, that cycle we talked about, and certain practices that disproportionately burden the most vulnerable members of society.
Yes, this is a crucial point, and it moves beyond just the numbers into the very nature of the industry and its practices. Critics argue, pretty strongly, that the core business model of payday lending inherently sets borrowers up to lose, that it relies on frequent rollover, not quick repayment, for its profit. Now, what's interesting is that while the industry might not be, extraordinarily profitable overall, we found average profit margins for pure payday lenders were around 3.57%, which is actually less than, say, Starbucks at over 9% for a comparable period.
Huh, less than coffee.
Right. But the method of achieving that profit is the key ethical concern. It's about how they make their money, not just how much.
Okay, so even if the raw profit margins aren't massive compared to other industries, there's still a very strong incentive for lenders to keep borrowers in debt, because that's precisely where the substantial revenue truly comes from those repeat fees. And this creates what you might call an antagonistic relationship between the lender and the borrower, rather than a cooperative one where both parties genuinely benefit from the loan being repaid quickly and successfully. It seems like a system that almost thrives on financial distress.
Precisely. That's a good way to put it. To elaborate, let me break down some of the most severe ethical issues identified within the industry that really contribute to this antagonistic dynamic. First, and perhaps most central, is the issue of frequent rollover. We've already touched on how common this is, right? Over 80% of payday loans being reborrowed within a month, usually right when the original loan is due. The data also shows that only 36% of new payday loans are actually repaid in one term without reborrowing.
Only about a third.
Just about a third. This widespread inability to repay clearly indicates that the loan structure often doesn't give borrowers a fair chance to escape the cycle. Lenders directly benefit from additional fees and interest on these rollovers. And studies show that when states limit rollovers, payday storefronts actually close down because repetitive lending accounts for such a significant portion of their revenue, sometimes as much as 70%. Their profitability is tied directly to borrowers getting stuck in that cycle of debt.
70% of revenue from rollovers.
Yeah, wow.
Second, there's the problematic practice of misleading advertising. Historically, payday loan advertising has been heavily criticized for, well, downplaying the long-term effects, the rollover risk, and the true extent of the fees. They often use appealing, yet potentially deceptive, phrases like quick cash and heavily highlight no credit check to attract desperate individuals. It's quite telling that both Google and Facebook notably banned these types of ads due to their potentially manipulative nature, recognizing how they could lead people into harmful financial situations.
Right, the platforms themselves saw a problem. Exactly. And this misleading advertising contributes directly to loan misuse. Despite being marketed as emergency funds, a staggering 69% of borrowers actually use these loans for recurring expenses like rent, utilities, and food, which indicates a fundamental mismatch between the advertised purpose and how people are actually forced to use them. The third major ethical issue is the failure to assess borrower ability to pay. This is quite astonishing when you think about it. Payday lenders typically only ask for a borrower's ID, proof of employment, and crucially, access to their checking account. They generally don't perform thorough underwriting or comprehensive credit checks to determine if a borrower can actually repay the loan without immediately needing to reborrow.
So they don't really check if you can afford it long term.
Not in the way a traditional lender would. This irresponsibility puts borrowers at extremely high risk, as interest and fees can quickly spiral and exceed the principal amount borrowed. For example, research indicates that an average borrower takes out 8 $375 loans per year and ends up spending $520 just on interest.
More in interest than the original loan amount, potentially.
Often, yes, over the course of a year, that's money that could have gone to actual needs. This lack of due diligence puts the burden of responsibility almost entirely on the already vulnerable borrower, essentially setting many up for failure from the start. And finally, we encounter abusive collection strategies. These are particularly egregious and really highlight the problematic nature of the business model. One such strategy is what's sometimes known as first pass, on paychecks. Remember, when you take out a payday loan, you often give the lender a post-dated check or electronic access (ACH) authorization to your account. On payday, the lender prioritizes taking their payment directly from your account, often before other essential bills like rent or utilities get paid.
They jump to the front of the line?
They absolutely do. And this can lead to serious consequences: overdraft fees from the bank, potential account closures, and it forces borrowers to miss other critical payments. Studies have even found that access to payday loans made food stamp usage 20% more likely and child support payments 10% less likely in low-income households. It fundamentally reshapes a borrower's financial priorities in a way that can cause further distress and potentially double poverty. Another abusive strategy within collection is the requirement for lump sum repayment. Payday loans generally require full repayment, the entire principal, plus all the fees in a single installment on your very next payday. This is a huge, often impossible burden for financially strained borrowers, especially since, let's face it, most financial crises aren't resolved in just 2 weeks.
Right. The problem that caused you to borrow is likely still there.
Exactly. And genuine financial security certainly isn't achieved with just one paycheck. This structure almost inevitably forces borrowers into the very rollover cycle that generates profit for the lenders, making it incredibly difficult to break free from the debt.
So when you lay out all these practices like the rollover dependency, the misleading ads, not checking ability to pay, the collection tactics, it truly feels like a system that's almost designed to be a trap, designed to ensure that borrowers will struggle. I even read about a really disturbing case in Texas where some payday lenders were apparently dating checks for the day the loan was given, knowing full well they would bounce. Then they would sue borrowers for writing a hot check, even though they were aware the funds weren't there in the first place and it was part of their loan agreement.
That's deeply concerning.
Yeah. And some people even face threats of criminal prosecution for check fraud, even though that's explicitly illegal in many places for this type of loan default. It's truly shocking to see such aggressive tactics used.
Unfortunately, yes. These practices create a system where the lender's interest lies fundamentally in the borrower's inability to repay successfully on the first try. This fundamentally contradicts the whole purpose of lending as ideally a cooperative, beneficial relationship that helps both sides. It's a complete reversal of the typical lending dynamic, where a lender genuinely wants you to succeed and pay them back on time. Instead, it places a disproportionate and often crushing burden on the least advantaged, on those who are already struggling with financial insecurity and limited options. And this is precisely why the ethical criticisms of the payday lending model are so severe and so persistent.
Which brings us then to our fourth key takeaway. While the payday loan industry consistently argues it fills a vital gap for those without access to traditional credit, the growing body of evidence suggests that its benefits are often significantly outweighed by the severe costs, particularly for repeat borrowers, frequently leading to more harm than good for many individuals and families.
Right. Proponents of payday lending frequently argue, look, our charges are directly in line with the high operational costs associated with providing these small, short-term, and inherently high-risk loans. They claim that if their interest rates were significantly lower, these loans just wouldn't be profitable enough for them to even exist.
The cost of doing business defense.
Exactly. They also point out that in what they see as a perfectly competitive market, if one lender reduced fees significantly, others would quickly follow suit, negating any competitive advantage, which, they argue, often leads most lenders to simply charge the maximum fee or interest rate allowed by state law, which, as we discussed, can be as high as 400% APR or sometimes even more. They essentially view this high pricing as a necessary model for the niche they serve, required to offset the risks and costs involved.
And the industry also frequently claims it provides a necessary, maybe even essential, service for people who have truly exhausted all other credit options, preventing them, they argue, from turning to illegal loan sharks who operate entirely outside the law and might use violence. It's often presented as a kind of democratization of credit for the poor, giving them access to funds when traditional banks simply won't lend to them. So it's framed as a vital lifeline.
That's certainly a common argument you hear, and it definitely resonates with a fear of a potentially worse alternative.
Hmm.
However, studies looking into this have found little, if any, evidence of people actually turning en masse to illegal loan sharks in states where payday lending is prohibited or strictly limited by rate caps.
Oh, really? So that argument doesn't hold up well.
Not according to the research generally. In fact, what happens more often is that borrowers in those states might turn to friends or family, or perhaps find other community resources, or even just tighten their belts further to pay off debts or manage expenses. This suggests that other, less predatory alternatives often do exist, even if they aren't formal financial products from a storefront. It directly contradicts the loan shark argument quite effectively, indicating that communities and informal networks often step up when these high-cost options are removed.
Okay, interesting. What about the overall impact on household welfare then? I mean, I've seen some arguments, maybe from industry-funded studies, that payday loans might actually improve welfare in the short term by relaxing credit constraints during emergencies. Giving people the immediate cash they need to avoid even worse situations like an eviction or having their utilities shut off. Is there any truth to that, or is it universally negative?
That's a really nuanced area and is where the academic research provides somewhat mixed signals, which truly reflects the complexity of real-world financial situations under stress. While some studies do suggest a potential short-term positive impact by providing immediate access to credit when absolutely no other options seem available, for instance,
Yep.
helping someone avoid a utility shutoff fee that might actually be higher than the initial payday loan fee.
So a very specific, narrow benefit, maybe?
Possibly, in some very specific cases.
Hmm.
But many other studies strongly indicate that the high costs associated with repeated rollovers significantly reduce a household's long-term financial health, impacting their ability to pay recurring bills and expenses for months or even years down the line. For instance, one study found that while bankruptcies did double among payday loan users compared to a control group, the overall increase was considered too small to be statistically significant in the broader population context.
So more bankruptcies, but maybe not widespread enough to be conclusive proof.
Exactly. However, other research indicates a persistent increase in defaults on other debts and finds that consumers are more likely to exceed their bank overdraft limits after taking out payday loans, which strongly suggests a worsening financial situation over time, not an improvement. So while the immediate welfare impact is perhaps debated in academic circles, the overwhelming majority of personal stories we hear directly from borrowers highlight the devastating long-term negative effects on individuals and families. That anecdotal evidence is powerful.
Right. The lived experience often tells a clearer story. Okay, this brings us to our fifth and final key takeaway today, and it's actually an encouraging one. Regulatory efforts and the development of new financial products are actively creating safer, more affordable alternatives to traditional payday loans, offering what seems like a brighter path forward for those in urgent need of small dollar credit.
Yes, that's a truly encouraging development. And it marks a significant and, frankly, much-needed shift in the financial landscape over the last decade or so. Historically, if we look way back to the early 1900s, there were these salary lenders charging well over 100%, maybe 120% APR or more, which led to widespread concerns about usury and predatory practices back then, too.
So this isn't exactly a new problem.
Not at all. Laws like the Uniform Small Loan Law tried to set caps, typically around a much more reasonable 36% to 42% APR, aiming to protect consumers from those exorbitant rates. But then in the 1990s, modern payday loans emerged, pushing rates back up to 300% and above, often by getting specific statutory exemptions from state usury laws. They found loopholes. And this period also saw bank overdraft fees become a huge revenue stream for banks, exceeding $15 billion in 2019, primarily because overdrafts were often treated legally as a service, not technically a loan, which allowed them to bypass certain consumer protections like APR disclosure requirements that applied to traditional lending.
The overdraft service fee loophole.
Precisely. It was a clear area that needed addressing for consumer protection.
So it really sounds like there was a real urgent need for change, especially since, as you mentioned, studies showed that 8 out of 10 payday loan customers who had checking accounts said they would actually prefer to borrow from their own bank if they could get a similar small loan there. That indicates a strong preference for more traditional, potentially safer options that simply weren't available to them at the time.
Precisely. And regulators, particularly federal banking regulators like the OCC and FDIC, have been actively encouraging banks and credit unions to step up and meet this demand responsibly, rather than leaving this void for high-cost lenders to fill unchallenged. We've seen a significant shift away from those early bank deposit advance products, which frankly mirrored payday loans in their problematic, high-cost lump sum repayment structures, towards more responsible, consumer-friendly offerings. By 2018, U.S. Bank became a real leader in this movement. They started offering a true credit alternative to payday loans, a small dollar loan product available even to those with damaged credit histories, crucially repayable in affordable installments over several months, and costing only a small fraction, maybe 15 times less than a typical payday loan.
15 times less. That's a massive difference.
It's a monumental shift. And the good news is by 2023, 6 of the 8 largest banks in the U.S. offered similar responsible small loans. And many also substantially improved their overdraft programs by either eliminating those fees altogether or significantly reducing them or offering grace periods. This is truly a game changer for millions of individuals who now have access to vastly superior options from institutions they often already know and trust.
That's genuinely fantastic news. So beyond the big banks, what about state laws? Have they kept pace with these developments and the evolving needs of consumers? Are states stepping up too?
Absolutely. The regulatory landscape at the state level has also seen some really positive transformations, creating a much safer environment for borrowers in many places. Payday lenders now operate legally in 32 states, which is actually down significantly from over 40 states back in the mid-2000s.
Okay, so fewer states allow them now.
Right, reflecting a clear trend towards greater state-level consumer protection through rate caps or other restrictions. States like Colorado, Hawaii, Ohio, and Virginia have notably modernized their laws. They've moved away from allowing those single-payment payday loans and replaced them with requirements for installment loans that cost 3 to 4 times less on average. And crucially, these reforms have successfully achieved a vital balance. They've made loans significantly safer for borrowers while ensuring that credit remains widely available from state-licensed lenders. This effectively dispels the industry myth that strict regulation would eliminate access to small-dollar credit entirely. It shows that responsible lending is possible and sustainable.
That's really important context. Okay, so this is where we can talk about some concrete alternatives you, our listeners, might consider if you ever find yourself in a tight financial spot, so you can proactively avoid those high-cost, high-risk loans we've spent so much time discussing today.
Yes, and I think this is incredibly important practical information for you to have in your back pocket, just in case. Before turning to a high-cost payday loan, I strongly encourage you to explore these more affordable and safer options that are becoming increasingly available. First, and a truly excellent option if you qualify, is to explore payday alternative loans, or PALs, from federal credit unions. If you've been a member of a federal credit union for at least a month, you could be eligible for a PAL. These loans typically range from $200 up to $1,000, with repayment terms from 1 to 6 months. And crucially, the APR is capped at 28%.
28% versus nearly 400%. Huge difference.
A stark, dramatic contrast to the 300, 800% rates you might see from some traditional payday loans. And as an added benefit, many credit unions also offer free financial counseling services to their members, which can provide invaluable support in managing your finances long-term, not just providing a loan. Second, definitely consider personal loans. Even if you have a less than perfect credit score, you might still qualify for a personal loan from a bank, a credit union, or perhaps an online lender. While the interest rate might be on the higher end for someone with a lower score, it will almost certainly be much lower and more manageable than what payday loans charge. And an added benefit is that personal loan lenders typically report your positive payment history to the credit bureaus, which can actually help you improve your credit score over time rather than trapping you in a cycle of debt with no positive reporting.
Right, it can be a credit building tool potentially.
Exactly. Third, don't overlook payment plans. If you're facing a shortfall because of existing debt obligations, maybe it's utilities, medical bills, even rent or a credit card bill, pick up the phone and contact your creditors directly. Many are surprisingly willing to negotiate reduced monthly payments or provide more time to pay, or maybe even waive late fees if you explain your situation. While this might slightly increase your overall interest paid in some cases, like on a credit card, it can prevent you from needing new, high-cost loans, allowing you to manage your current situation without digging a deeper hole. A simple phone call can sometimes save you hundreds. Fourth, cash advances from credit cards can be an option in a true emergency. Now, they're still more expensive than regular purchases on your credit card, as they typically come with higher interest rates and interest accrues immediately with no grace period.
Yeah, definitely not cheap.
Not cheap, no, but they're usually significantly less costly than a payday loan. It's certainly not ideal for long-term borrowing, but in a genuine short-term emergency, it's often a better bridge than an AFS. Fifth, borrowing from family or friends is often a zero-interest option, which can provide immediate relief without the burden of fees or high interest. However, it's incredibly important to carefully consider how this might impact your relationship. And I'd strongly advise having a clear, maybe even written plan for repayment to avoid any strain or misunderstanding down the road. Treat it professionally, even if it's personal.
Good advice. Avoid awkwardness later.
Definitely. Sixth, some employers offer employer advances on earned but unpaid wages. This means you're essentially accessing money you've already worked for but haven't yet received in your paycheck. It's basically an interest-free loan from your employer tied to your earnings. It's absolutely worth checking into if your company offers such a program. Seventh, investigate emergency assistance programs. Check with your state or local government agencies as well as local nonprofit organizations and charities like the United Way or Salvation Army. Many offer direct financial aid, utility assistance programs, food banks, or can connect you with other critical resources during a crisis. These programs are specifically designed for moments like these. Don't hesitate to reach out. And finally, while it's also a high-cost alternative financial service, pawn loans use collateral, your physical item, rather than relying on your next paycheck or direct access to your bank account. This can sometimes be a slightly less dangerous option than the payday loan cycle, as you don't risk bank overdrafts or aggressive collection calls if you default. Though, of course, you do risk losing your valuable item if you can't repay the loan.
It's definitely not ideal, but it often avoids that spiraling debt trap associated with rollovers and bank access.
Those are some really practical alternatives to keep in mind. I remember one particularly striking personal story I heard where a friend's family member avoided needing a payday loan entirely because they suddenly received a $1,000 check from a class action lawsuit against a previous payday lender they had used years ago.
Wow. Talk about poetic justice.
Right, turning a past negative into a present solution. Another friend told me they simply looked up the maximum legal interest rate allowed in their state, found a lender charging more than that, and then, after getting some legal advice, they refused to pay the excess interest, threatening to report the lender to the state authorities. Apparently, it actually worked because the lender knew they were operating illegally.
That takes some nerve, but highlights the power of knowing the law.
It does. And I also read about someone who literally called their state's attorney general's office when they were being hounded for an online payday loan, and the AG's office advised them to just close their bank account because those types of loans were completely illegal in their state, and the lender couldn't legally collect on them there. Now, these are maybe extreme and probably rare examples, but they truly highlight the urgency people feel, the potential for severe consequences, and also the immense power of knowing your rights and the specific laws in your state.
They absolutely do. And they underscore that while payday loans are legal in some states and are sometimes unfortunately positioned as a last resort, they should truly be the absolute last resort, if ever considered at all. Many people who've been through what they vividly describe as payday loan hell themselves strongly advise against ever using them. They often share these heartbreaking stories of paying thousands and thousands in interest on relatively small initial loans, being pushed into bankruptcy solely because of these loans, or even facing terrifyingly aggressive collection tactics that sometimes included physical threats to their families.
Gosh, physical threats. That's awful.
It's unconscionable. And that's why building even a small emergency fund, even just $500 or $1,000, is often cited as the best possible payday loan from yourself.
Nice.
It allows you to create that crucial buffer against these inevitable financial shocks, giving you real options and breathing room when emergencies inevitably arise. Without the crushing burden and the potential danger of high-cost debt, it's really the ultimate form of financial self-defense against these predatory products.
That's a great way to frame it, financial self-defense. Okay, we've covered a tremendous amount of ground today. From the precise definitions and the widespread prevalence of payday loans, all the way through to their complex ethical implications and, thankfully, the truly evolving landscape of alternatives that are now emerging. Let's quickly recap our main takeaways just so you have a crystal clear picture of everything we've discussed.
Sounds good. That brings us to takeaway number 1. Payday loans are widely used, and for many, unfortunately, they become a persistent and deeply entrenched part of their financial life, rather than just a fleeting one-time solution.
That brings us to takeaway number 2. People often turn to payday loans during times of significant financial shock, revealing that paradox where even when seemingly lower-cost credit might technically be available, the sheer scale of the financial crisis often exceeds all other immediate liquidity options combined.
That brings us to takeaway number 3. The payday lending business model itself is often criticized as inherently unethical, primarily due to its structural reliance on repeated borrowing and certain practices like misleading advertising and aggressive collection tactics that disproportionately burden the most financially vulnerable.
That brings us to takeaway number 4. While the payday loan industry argues it fills a vital gap for those without traditional credit, the overwhelming evidence suggests that its potential benefits are often significantly outweighed by the severe costs and long-term harm, particularly for repeat borrowers.
And finally, that brings us to takeaway number 5. Regulatory efforts at both the state and federal levels, alongside new financial product innovations, are actively creating safer, more affordable alternative to traditional payday loans, including responsible options from major banks and credit unions that are dramatically transforming the small dollar loan market for the better.
As we conclude today's deep dive, I want to leave you with a final thought to mull over. If the fundamental problems that lead people to need high-cost loans in the first place persist, problems like stagnant wages, insufficient emergency savings, limited access to truly affordable credit for everyone, and just general income volatility, what deeper, more fundamental societal changes might be needed? Changes to ensure everyone has access to genuinely fair and affordable credit when they need it, so no one ever has to choose between extreme debt and truly dire circumstances. That's a big question, but definitely one worth pondering as we move forward. That's all for now, folks. Please like, share, and subscribe for more like this.